Hello, and hope you're having a great day. It's Dr. Vicki. Today we're going to be learning about the balance sheet. So this is a very important chapter because we're going to learn the different sides of accounting. And so it's a little bit more difficult as of this chapter. So again, please reach out to me if you have any questions. I've already been on some sessions with students and helping them through homework, usually in the evenings or anytime on the weekends. But if you have questions that you want to send by email, I can try to answer them as well. So as we move forward in the chapter, I just want to say that as I'm doing this, I am also taking care of my granddaughters who are ages 1 and 2. So you may hear them every now and then in the background, but I hope it does not distract you from listening to the lecture. So here we go. So the balance sheet helps to identify the different effects that different transactions have on the business. And this is one of the most important financial statements that business owners can learn how to read. If they know how to put one together and how to do the counting, that even is best. They may not do the accounting themselves. They may hire a bookkeeper, but in order to understand their business and how it's doing, they really need to understand the balance sheet. And that's one of the goals that I have for myself, is not only to do bookkeeping for others, but also to help them understand what they're seeing. So as we were introduced on our last lecture, assets equals the liabilities plus stockholders' equity. And so just to reiterate, the assets are resources the company controls and expects to benefit from. So one example is inventory. So they own their inventory. If they sell products, that is a resource that they expect to get money from in the future, and that's what that's all about. Another example of assets is cash in the bank. It might be just sitting in the bank today, but they expect to use it to pay for more inventory or supplies or advertising. All of those things are going to benefit the company. When we move on to liabilities, these are measurable amounts that the company expects to give up at some time in the future. For example, when bills come in, they don't automatically pay their bills on the same day they get them in the mail, but they want to be reminded that, okay, we got these bills coming, we need to remember them, we need to remember to pay them. So what they do is they put it in their accounting system as a liability or an account payable. You want to think about bills like utility bills, bills for inventory, things like that, things that are generally going to be used within a year or have already been used, like your utilities. You always get the bill after you've used it. Those kinds of things are short term and they always go in our accounts payable. Another kind of payable are notes payable. Generally, they will be longer term and more than a year. Generally, that's not always the case, but loans that will take more than a year to pay off, for example, like equipment, you may buy thousands of dollars worth of equipment. Of course, you don't pay it all off in the same year unless you're really blessed and can do that. So it takes maybe 5 years to pay it off. Those kinds of things are long term. So then your liabilities are added to your stockholders' equity. Stockholders' equity are the funds that owners have actually put into the company or the net income or profits that the company has made. Now, if the profits are negative, of course, those are losses. Those will actually reduce the stockholders' equity and reduce the amount of ownership that people can share. And that, in other words, the owner's claim to the business resources. Okay, so if you have a sole proprietor, he or her is the one that controls the assets, that controls the liabilities. If you have a corporation, your stockholders, most of the time, now some of them are the executives and people who work in the company, but most of the time, the majority of funds may come from people that just sit back and watch their stocks increase in value or decrease in value. So that's another part of stockholders' equity. All right, financing and investing activities, two different things. So, and they involve liabilities and stockholders' equity. So, in order to obtain assets like inventory, equipment, especially if the business is just getting up and running, they're going to look at two different kinds of financing. And whatever the company decides is based on how they want to run their business model. If they want to have debt financing, what that means is they'll go to a bank or a finance company to get loans. Generally, this kind of financing are long-term loans because they're asking for capital investments. For example, when they buy equipment, usually I would say anything more than $1,000. It's kind of at the business's discretion how much they determine what can be expensed and what has to be an asset. But most of the time, equipment is an asset, so you cannot reduce the income right away when it comes to the larger type purchases. But debt financing from banks or finance companies is debt that has to be paid back and usually with interest. The equity financing is from shareholders or the business owners, and that is money that goes into the company and it just sits in the account as an amount while the cash is being used. For example, owners may come in with $2,000 for maybe a small company, maybe an accountant wants to do some public accounting on the side, so they have $2,000 they can invest. So they will put $2,000 into the company. So it's an asset right now because it's sitting in cash, but they'll use those assets to buy software, maybe buy a computer, those kinds of things that are going to sit as well as an asset because, again, we'll get to this later, but some things that you pay money on, you cannot take off as an expense right away. So the equity financing is the money that owners put into the company. Now, you don't pay interest on equity financing. What happens there is that if there are profits, sole proprietors and partners may choose to do a distribution of those profits. It doesn't have to be all of them, of course, because they want to retain some of the earnings in order to keep the business running, in order to buy more capital items, things like that. So what that term is called is retained earnings. So the money that's kept in the company is called retained earnings. And remember that retained earnings is not a liability. This is not money that is owed to the owners. It's just earnings that have been retained. So it's part of the stockholders' equity or the owner's equity. As far as a corporation, if the company has profits and they get to the end of the year and they have a lot of extra money, they may decide to do a dividend. So they take the number of shares outstanding, they take the value of one dividend, the value of the stocks that they have, and determine how much of a dividend they're going to get. For example, let's say they're going to distribute 31 cents per share. So if I had 100 shares, they're going to distribute $31 to me in the form of a dividend. Okay. So financing activities, they have some key features. So when transactions are considered or when they're analyzed, there's three things that we want to make sure happens during these transactions. So the first thing you want to do is always document the activities that are going on. You always want to have receipts, even the receipt that you get from McDonald's from having a meal one day with a business partner or a customer. You want to keep that receipt, put a date on it. Why does it pertain to the business? And especially you want to keep the receipts that are more than $75. There's some applications out there that you can take a quick picture, put it on your application, and you're good to go. All right, but you always need to have a document. Another example of documents are contracts. So we'll get into some of those examples in just a moment. Then the company wants to receive something, and then they need to give something away. So it's a two-way transaction. Remember in chapter 1, we learned about accounting transactions always have two sides. So you are always receiving something and giving something. And then the amounts on a transaction, they have to be measurable and measurable with impact to the company. Now you're going to have an example in your homework that says that a shareholder gave up some of his shares to his neighbor. Well, that does not impact the company at all. It only impacts the two neighbors. And they just have to report to the company that the name has changed. There is no actual accounting transaction in that kind of thing because it's not impacting what the company has. There are also two different kinds of exchanges. You're going to have exchanges that are external, that involve purchasing assets or creating liabilities or stockholders giving you money, that you can see between the company and someone else or a third party. Then we have internal events, such as using some assets to create an inventory product. And what that is saying, when you are a manufacturing company, you're going to buy several things to put your components together for the products that you're making. So that is something that's done internally. However, it is still a transaction because now what happens is that you have an account for supplies for manufacturing that you're going to decrease, but you're going to then increase your inventory. And that'll make more sense in just a minute as we get into the different kinds of transactions. So that process is known as analysis to the accounting transactions. You're actually thinking about what exchange happened and what two sides are going to be impacted, what two sides of the balance sheet at this point. So you're going to analyze, then you're going to record, and then you're going to summarize. So what we just talked about was analyzing the transaction. The transaction is a business activity that affects the basic accounting equation. So the duality of effects means that every transaction has at least two parts, two impacts to the balance sheet. And you have to remember, though, that whenever you're dealing with transactions, your assets has to equal your liabilities plus stockholders' equity. Now, you will see that in some of these transactions that you're going to have both pieces of the transaction in one side of the balance sheet. For example, when you buy supplies, your cash and your supplies accounts both are asset accounts. The cash is going to go down and your supplies inventory is going to go up. The value of the supplies is going to go up. The value of your cash is going to go down. So in other words, according to the equation, because you have a plus and a minus, your equation stays intact. When you're thinking about purchasing equipment with some debt financing, as we talked about, the debt financing is a liability. So you're purchasing equipment, which is going to go on your asset side. It's going to increase the value of your equipment. And then your liabilities are going to increase because you're adding debt to your business model. So in that case, you're increasing an asset and you're increasing a liability. So those things are going to keep the equation balanced. So those are the things you have to think about. Is it always just two pieces to a transaction? No, sometimes there can be two, three. Sometimes journal entries are very long because especially when you're buying a building or something, you've got different kinds of costs and different kinds of accounts that it's impacting, so they could get quite long. But in this course, we are generally going to be working with transactions that have two or three. I have not seen any that may be four pieces, but just keep that in mind that it's not always just going to be two parts. It may be three, but you're always going to have at least two. All right, so the chart of accounts is tailored to each company's business, and this is really dependent on what the business does, what they want, what the managers want to see on the balance sheet, and then also they have to consider what do third parties want to see on the balance sheet. So obviously you have your high-level account names like cash, accounts receivable, accounts payable, and your stockholders' equity, but then you can have a lot more categories within each section in order to explain more what's going on with the business. So this is an example. You will notice that there are account numbers, and usually within a general ledger system, sorry about that, usually within a general ledger system, the account numbers have a purpose. So here you will see that assets start with a 1. The liabilities start with a 2, and then the stockholders' equity start with a 3. So those are generally across every company. The only difference is their categories may be different. So let's look at this first transaction. And as we go through these, your homework is set up very similar. You're going to have a series of transactions that you're going to analyze, and then you're going to do what we call the journal entry, and then you're going to put it into a T account, so you're keeping track of your accounts, and that'll make more sense in just a moment. So in this first transaction, on August 1st, the company issues some common stock to Jordan and Ty as evidence of their contribution of $1,000 cash, and the $1,000 is represented by the cash and the stock to the stockholders. So as you can see here, the company is receiving cash and gives a stock certificate. So there's the exchange. The exchange is cash, is received, and the company is giving the stock certificate. So your journal entry will look something like this. So you're going to have cash increases 10,000 and your common stock increases 10,000. The next example, the company is going to pay some cash to have another company create the company's logo. So the exchange is receiving the logo, which is services that they're going to pay for, but in exchange, they're getting this logo. And then the company is going to give $300 cash in this transaction. So this is one where the two assets are impacted because logos, copyrights, trademarks, those kinds of things, even though it may be a picture, it has value and can possibly be sold in the future. Also, these kinds of items cannot be expensed. So the logo and trademarks will go on the balance sheet as an asset. So that's going to increase because the value of your assets are increasing. The value of your cash is decreasing because they're paying cash right away. So you're going to see both of those transactions on the asset side. Next, we're receiving a loan from the bank. So the company borrows $20,000 from the bank and deposits it into their checking account. In exchange, they are signing a document that says, I'm going to pay this much a month for this number of months. So that's the exchange. And usually this kind of amount, most companies, especially the smaller ones, do not pay it off within a year. So we call it a note payable because it's a long-term liability. Your transaction is going to look like this. So this is what we talked about before. Your cash is going to increase going into your bank account. Your note payable and the liability side is going to increase. So again, both sides of the equal sign are balanced. The next one, the company receives equipment and computers, printers, things like that, $9,600 worth, in exchange for a promise to pay. The difference between a promise to pay and some payables or notes payable is that a promise to pay indicates a short-term promise. So what they do is the company is receiving the equipment and they exchange a piece of paper that says, I'm going to pay this $9,600 at this time in these amounts. Okay? So that's a promise to pay. Again, increases the liabilities, increases the equipment. This next example that we have, the company is buying $5,000 of equipment to an equipment supplier. So they are giving cash in receipt for the equipment. So they have the document that says that they bought this equipment for $5,000. This actually is referring to the equipment that we bought in D. So the company is paying towards that promise. So your cash is going to increase $5,000, and your accounts payable, your promise to pay, is going to decrease $5,000. Again, both sides are equal on either side of the equal sign. All right, this one is a little bit different. Keep in mind that transactions have to result, a recorded transaction has to be resulting in the exchange being completed. So here, Noodlecake signs a contract with a programmer for program code for $9,000. The code has not yet been received yet. That's the most important part. The document is signed, they have a signature, but nothing has come from the third party yet. Do we record this transaction? No. This promise to pay simply is that it's just a promise to pay if Enchanted World complies with the contract. So there's no impact at this time on the exchange. So when you're doing your homework, a lot of people, when they put zeros, are getting an error and not getting it correct. So because there is no change. Try typing no change, and that may work. I'll have more on that in just a moment. That thought had just come to my mind when I saw the no change. So I'll confirm that for you. All right. So now, from the transaction we had in F, where there was no transaction yet because the code was not received, now the company has written the code, and now the company is liable, or has that liability that they have to take care of. So now, because Noodlecake has the software, they have decided to break the promise to pay into two parts, $4,000, and gives a promise to pay the other $5,000 on account. So this is where we have 3 steps in the transaction. So your software, the code that was written, is worth $9,000. That's your asset. Again, due to the amount, you cannot just expense it off. Assets with a larger value generally are always booked as an asset. You cannot expense it. First part of the other side is the company gives $4,000 cash at the time and then promises to pay $5,000 later on. In this transaction, the $9,000 is decreased by the $4,000, so you have your $5,000. So again, your software is worth $9,000 less your $4,000. The total on the asset side is $5,000. The total on the liability side, then, the promise to pay, is $5,000. So that's how you make sure that both sides of the equal sign balances. Here we're receiving some supplies, like office supplies, little sticky notes, and pens and paper and things like that. So those kinds of things, Generally, a company may expense them right off the bat because they may not buy a lot at one time. But if there is a lot purchased and you have a closet full of supplies, you cannot expense it until you use it. So again, this amount of office supplies, $600, is going on an account, like an account payable, and then the value of the supplies, which the company is receiving, is $600. And this is familiar from our other transactions. Assets are increasing and your account payable is increasing as well. All right, so now you are going to record and summarize. And the way to record and summarize the financial effects of transactions would be to enter your understanding of their effects into the spreadsheet. So here, along this column, the letter represents each of the transactions. So the first transaction, that's where we took in the stockholders' equity, our cash account increased, and our common stock increased. The $300, that's when we had paid for the logo. So our cash went down by $300 and our logo went up by $300. All right. The next one, I believe this was equipment. So, no, this was the loan. So our cash increased and our long-term note payable increased. Again, on opposite sides of the equal sign. The $9,600 in equipment that was exchanged for a promise to pay. You have your asset here booked, and then your promise to pay and your account payable. Then we have the $5,000 that we paid towards that equipment. So the $5,000 came out of your cash, but keep in mind, your equipment is already booked at its full value. What has to be decreased is the account payable because you're paying towards that promise to pay. So that is what's decreasing, not the value of the equipment. Okay, and then that way your balance sheet is still in the same on both sides. In F, you would put no change because this is where the company signed a contract but did not receive anything for the contract yet. And then in G, that's when we actually received the software, so we booked the asset. At the time, we gave them a $4,000 down payment and the $5,000 promise to pay. So your $9,000 less your $4,000 is $5,000 equals the other side, which is $5,000. And then finally, our supplies account, we increased supplies by $600. We didn't pay the cash for it yet, so our account payable goes up $600 here. And this is the way that you summarize the transactions. So that's how we record the transactions. Now we're going to summarize them in T accounts. Now, most of the time, companies have an automated system that does this, but it's important for you to understand the why and how it's done behind it, because sometimes computers fail, and you may need something right away. And let's say your computers are down, you have a balance sheet from a week ago, but you have a couple of transactions, and the bank needs it today. The bank needs a copy of the balance sheet today. You want to be able to know how to impact your balance sheet by manually making transactions in case that happens. So now you're going to use those journal entries that you created and put them in T accounts, because what this is doing is making sure that your assets equals your liabilities plus stockholders' equity. And think about it as a scale. This scale always has to be level. You can't be recording assets that are less than or more than liabilities plus stockholders' equity. That always has to be. So when you're thinking about the balance sheet and debits and credits, you really have to think about them as left side and right side and where the normal balance sits. Okay? Don't think about it along the same lines as your checking account or your debit card or anything like that, because it's totally opposite. You cannot compare the two. So on your assets, your normal balance, and when I say normal balance, that means when the balance is positive, your normal balance is going to be a debit balance. Let me give you an example. So let's say you come to the end of the month, you haven't received some of your cash yet, your checking account goes negative. Not only are you going to have fees that you have to expense, but your balance is going to change from a debit balance or left side balance to a credit balance, a negative balance on the right side. Okay? On the liabilities, when it comes to liabilities and stockholders' equity, your normal balances are going to be credits. Your total debits have to equal your total credits when you're doing a transaction. So, for example, the way a liability can be a debit balance. So, for example, when our wages are paid, we now owe the government, let's say $1,000 for taxes that have been withdrawn from the paychecks of the employees. So, a liability, the normal balance of $1,000 is going to be a credit balance or a right side balance. However, sometimes the payments are made in advance. So the balance then becomes negative because it's not that it's a debit or credit, it's left side, right side, debit or credit. Where does the normal balance sit? The normal balance for a liability, right side. If it has a negative balance or a liability has been overpaid, it's going to have a debit balance. Same with stockholders' equity. You come to the end of the year, the company does not make a profit, it loses money. The net loss is then recorded as a debit because it's going to be decreasing the owner's equity or retained earnings. This might not make a lot of sense right now, but as you go through the homework, I think it will some light will be shed as you're going through the homework. Again, this is one of the toughest concepts for people to understand. Please let me know if you have problems, and we'll work it out. I will show you with more examples, but I want you to succeed, and this is one of the most important parts you need to understand. So let me talk about liabilities for a second. When liabilities are a negative, it means that they have been overpaid. For example, a company always has liabilities after a payroll is run because it owes taxes to the state and federal governments. The normal balance would be on the credit, is a credit balance or the right side balance. If those taxes for some chance gets overpaid, the balance is going to sit on the left side or have a debit balance because it's negative. So this is a concept that is a little bit difficult to understand, but I believe after you go through the homework, you're going to understand it better. But I want you to understand this. I want you to succeed. Understanding this is going to help you do that. Let me know if you need help, and I will give you some more examples on a one-on-one, or sometimes I'll open up the class and say, my office hours are open. Please come visit if you have questions. Same thing for the stockholders' equity, similar to liabilities. At the end of the year, if the company does not make a profit, they have a net loss, meaning that the normal balance on the stockholders' equity or retained earnings did not go up. It actually decreased. Okay, it's using resources that have been previously earned, so the retained earnings has a negative balance. You would see that on the left side, or you would refer to it as a debit balance. Accounts increase on the same side as they appear in assets, liabilities, and stockholders' equity. You see this, the normal balance, that's the side where they increase. Wherever their normal balance is the side that they increase. The left is a debit, the right is a credit. The normal balance for account is the side on which it increases. So here we're recording our journal entries. We've already done that, similar to the boxes that were at the bottom as we were going through the problems. On this is actually called a general journal. This is something that you may or may not get familiar with because we've got computers. And so journal entries are now recorded in the computer, but in a similar fashion. You may not see the indentions, but you're going to see the two different lines. You're going to have a place for the description. You're going to have a place for the date. And then you're going to have a debit and credit column. You may have a reference column, like a check number, something like that. But this is how it looks on a handwritten or manual general journal. And I come from the era where we used to use these kinds of spreadsheets that were manual, that were paper. I worked for a hotel and went in, as I was working with night audit, we had this huge piece of paper that covered the whole desk. And I'm being serious when I say the whole desk, like an executive desk size piece of paper. We had about 10 to 15 different entities within the hotel that we had to write along the column on the left and then actually fill in the entries. And then at the end of the day, we had to balance at the bottom, all manual. At that time, we had some computer interaction, but not a lot to do our accounting with. So these three transactions, or this last one rather, this is how the journal entry looks in a computerized fashion. Your asset for the software is increasing. Your cash decreased, so you're going to have that on the credit side, and your account payable increased. So your 9,000 equals the 9,000 on the credit side. Getting back to the 9 and the 4, remember both of these are asset accounts. So this is showing your increase in your asset and your decrease in your cash. Once you have your general journal or your journal entries done in the accounting software, this is also done behind the scenes. This is what you call a T account. So this is actually keeping track of each account. You notice that there's a software T account, a cash T account, and your accounts payable. This is called your general ledger. Each account has its own internal ledger where it keeps track of the debits and the credits. Similar when you're looking at the computer screen. All right, we're going to go through this part a little fairly quickly because we are just looking at the different steps one more time: analyzing, recording, and then summarizing. Analyze, record, and summarize. Notice here, this is when your cash starts having a little bit more activity. The letters out to the side represent the letters of the assignment. So this is the purpose of a T account, keeping track of the entire balance of the category or account. Analyze, record, summarize. ARS, keep that in the back of your mind. So here's on the account payable side, you have a couple different transactions that were recorded. Your accounts payable, you have the $9,600 that increased the liability, the payable, which is that promise to pay, and then $5,000 was paid against accounts payable. So it's decreasing. Notice this cash account is an asset. The account payable is a liability. Look at the plus and minus signs. This side, the debits increase cash, the credits decrease cash. On the other side of the equation, debits decrease payables and credits increase. Another way to say that, the left side decreases and the right side increases. This is the one where the contract was signed, so there's no change in the accounts. All right. So again, this is the transaction where the code had not been received yet, so there is no change in the balance sheet accounts. Then they receive the software. Noodle Cake receives the $9,000 that was according to the contract, so the value of the software is $9,000. And they pay the $4,000 in cash. We've talked about this. Your debits on one side, credits on the other, or increases on the asset side, decreases on the liabilities, or decreases on assets, increases on liabilities. This here, the cash, of course, is a decrease. You have two parts of the assets happening here. And your cash is one that has most of the transactions since there's a lot of cash going in and out. And then finally, we receive the supplies on account. We record it. And then we put it in and then we summarize it. Looking at this from I'm just going to call it a global view of the business, is that you have all your journal entries over here and all of your T accounts over here. At the end of the month, you're going to want to, getting back to this, so at the end of the month, you are going to add up your debits for the asset side, subtract your credits. So that would be the way that you determine the ending balance of the cash and any of the other assets. And you see the ending balance is on the debit side or the left side of the assets. Your cash, software, logo, supplies, equipment, all of these are your assets. You have your accounts payable and your notes payable. Remember, your normal balance for this kind of account is on the credit side or the right side. So you would add up your credit side, which is your increases, reduce it by your debit side or the left side to get your ending balance over here. If at any time these balances are negative, you would be listing them in the opposite side. So now we have to prepare a trial balance. This is to ensure that we have our balances are equal, that conform to the equation. Our total of assets equals our liabilities plus the stockholders' equity. And then we also use a trial balance in order to do adjusting entries, and we'll get into adjusting entries towards the end of the course. So in your trial balance, you're actually listing the balances according to where they land, whether it's a debit balance or a credit balance, in the order of the balance sheet. So you have your assets at the top, then your account payables, then your payables or liabilities, and then your stockholders' equity, or in this case, the common stock that was issued. This time around, all of the assets have a normal balance that are listed in the debit side, and all of your liabilities and your equity has the normal credit balance, so everything matches your $40,200. Your debits equal your credits. So then we can prepare the balance sheet. This is a classified balance sheet because we're naming the accounts. Your assets are always going to be at the top, and your liabilities and stockholders' equity added together to get a total asset balance and a total liability and equity balance, and those two balances must equal. Sometimes if you are looking at things on the websites or different Google searches for a company's financial statements, you may find that the stockholders' equity and liabilities may be side by side with the assets. But generally, you're going to see them up and down like this. So notice the current part, current assets, current liabilities. These are things that will be used up within a year. So we have a tendency to increase and decrease our cash over 12 months, goes in and out. It's liquid, it's easily obtainable to pay your debts, as well as supplies. Normally, you're not going to buy a whole bunch of supplies that last more than a year, so that goes into your current assets. Everything else pretty much is a long-term asset because these things are going to last longer than a year. Same idea with your liabilities. Your accounts payable and your promises to pay are going to be current because you expect to pay for them within the year. Your notes payable is generally long-term loans. And then your stockholders' equity, there really isn't a long-term, short-term on stockholders' equity. It usually stays on the balance sheet unless changes in the stock has been confirmed by the board or the owners want to reduce the investment they have in their company. That's going to remain the same. So now we want a third party to say, okay, how are we doing? So they take it to the accountant and they ask, if I took this to the bank, what would they say? The easiest way for a bank to interpret the balance sheet and different things is by using ratios. So the current ratio is the easiest one that I believe can be obtained by looking at the balance sheet right off the face value. So this is saying your current ratio is equal to your current assets, which is your 21,300, divided by your current liabilities, which is 10,200. When you divide these two, divide the liabilities into the assets, you're going to get a 2-to-1 ratio. So for every 2 assets, you can pay, you have a dollar's worth of liability, which is a really good position to be in, because what this is saying is that they have cash enough to pay all of their liabilities in the current state. If this was flip-flopped, if your cash was only 10,200, but your debts were 21,300, this would be less than 1, and banks would probably not consider any lending because you don't have enough current assets to pay your current liabilities. Again, current assets are what's used within the same year. Current liabilities are what needs to be paid in the same year. So if it's flip-flopped, the bank's saying, you don't have enough cash to pay your liabilities. We're not going to be able to do this right now. What is and is not recorded? So things that are recorded have to be measurable, and they have to be acquired through an exchange. Other items like creativity and vision, you don't record those things because there really is no value to them. Unless it's a contracted value, like we did with the software for $9,000. That is based on the knowledge that the software developer has. That is measurable. That is in the contract. Initially, assets are recorded at the cost, and initially they stay on the records at cost. The value on the items, let's say equipment, the value of $9,600 does not go down. However, you will see later in the course where depreciation will actually expense some of that value. So let's talk about careers for a moment. So within my 30 years of work experience, I've done a lot of different kinds of accounting. I've worked for Denny's restaurants for 10 years, and 10 seems to be my thing when it comes to long-term in the companies that I work for. I worked for a multi-level marketing company who had offices internationally. And then I worked for a bank. All three different sectors of the economy, but all three involving accounting. In the Denny's area, I actually did a lot of different things within the restaurants that I worked for, but some of that time was spent in the office, counting cash, doing reports and things like that in the accounting system. When I worked for the multi-level marketing company, and for those of you that don't know, those are the kinds of companies where business owners get into a product that they like, that they want to support, so they become a business owner and then sell it. Some examples are, and I'm probably going to date myself, like Amway, Avon. Currently, there's things like Isogenics and different kinds of health things going on. Amare is another multi-level marketing. But this one happened to be dealing with Amway business owners, and we had offices in several countries, very small offices, 1 and 2 people offices. But that gave me the opportunity to travel internationally. But again, it was all accounting. I went in as a staff accountant right out of college and did the debits and the credits and the transactions and did everything for the full accounting cycle, and worked my way up to being the international accounting manager, where my sole responsibility was making sure the numbers were right and making sure that they were correctly reported to management. And then finally, and am still working with the bank, another industry within the economy, but again, banks have their accounting departments, but where I worked was in regulatory reporting. So I had to know how to read a balance sheet, how to analyze an income statement, try to figure out what the differences were from one reporting period to another reporting period. So accounting can cover a lot of different areas. But one thing that I always wished I would have done right outside of college was work for a public accounting firm right off the bat. Even if it was just 2 years or so, because a lot of times company, especially in corporate accounting, they're going to want someone with public accounting experience. So if you get the chance to work for a public accounting firm, it doesn't have to be one of the big 4, big 6, whatever it is now, but just in public accounting. And then you have your private accounting side, which are your corporations, your nonprofits, possibly government agencies. Every business we have in the world needs accounting, has regulatory reporting responsibilities for the most part, even if it's just income taxes or payroll taxes or something like that. Every company has to have an accounting side. So I encourage you, if you are in this, to go through accounting, to consider these different options. Think about your long-term goals as far as what you want to do when you get out. I know there are internships. The bank has an internship. Public accounting firms have internships. So take those into consideration. All right, so that ends chapter 2. Probably by now you may have already tried the homework, but hopefully this has helped you understand the balance sheet a little bit better and how to do transactions. Again, as always, reach out to me. The best way to reach me is by text, and usually within the same day, I can at some point get on the computer with you and help you out. All right, so take care and let me know how you're doing.